First of all, what is the market actually looking at? If you look at the move in ETFs, in the first 7 months of 2021, there's more inflows than there has been in the past years of 12 months. So why this attraction more and more towards ETFs?
There is an element of market risk on, and there is another element of ETFs being increasingly used to express that risk on view. So if you think about so far this year, absolutely equity inflows is on track to smash record, making 2021 a record year for ETF flows by quite a bit of margin in comparison with previous records as we just looked at. But at the same time, we're also in an environment where we have very strong growth dynamics, above trend growth dynamics, and coupled with supportive central bank and very negative real rate. And this is a very potent mix for risk assets to have done well and also continue doing well in our view, which is why going into the rest of the year, we are pro-risk. And that certainly has been borne out by the momentum that we have seen on the flow side as well.
Wait, how should we actually look at inflation? So 3 weeks ago, the market was freaking out because they saw a bit of inflation. Then we have a big inflation print, and actually they seem pretty cool about it. So what exactly is going on? What's the next? Is there a correction coming up that could be triggered by inflation? Or will they wait until later in the year to understand exactly how, what it means for interest rates in 2022?
We actually believe that we're entering a higher inflation regime, and it's driven by both near-term dynamics that have everything to do with restart, and also by medium-term drivers, including supply chain shifting, including central banks' target to want to drive inflation above target for a sustained period in order to make up for past misses, as well as this concept that we call fiscal dominance, which is that as debt rises, debt to GDP ratio rises, rates cannot move too high too quickly. Otherwise, we have a debt servicing issue, which is a bigger problem than rising inflation. And all of that clears the path for inflation to push higher in the medium term, which we believe is somewhat underappreciated by market, which is why we recently upgraded U.S. inflation-linked bonds at the expense of nominal bonds.